Good morning, Trader First Year. This is the 4/28/2021 morning forecast. Markets are implying a move of 1.08% up or down on the S&P 500. Markets have realized a move of 0.68% up or down. The difference between what market makers are implying and what has been realized has increased. The spread widened to 649 basis points. The put-call gamma imbalance favors put buying relative to call buying. Short put-call gamma on client purchases has the potential to exacerbate market sell-offs. However, a widening spread increases left tail risk and the potential for spikes in realized volatility. Realized volatility has decreased recently below 11. This is favorable for smaller moves up or down on the indices. I expect a decreasing trend over the second quarter during April, May, and June. The current market environment is favorable for traders looking to sell convexity via short straddles, strangles, call overriding, put rights, and other short ball strategies to capture alpha. The move index hovers around 60 to 65 or movement of 3 basis points daily in Treasury yields. However, economic growth upgrades and rising inflation expectations were pushing up real yields and raising discount rates. The rise in yields has diminished, lessening negative effects on long-duration assets, such as technology stocks and long-term bonds. The S&P is expected to move close to 1.27% up or down this week, which means the S&P could rise 16% or fall 13% above its 200-day moving average, which is 3,630.20. The S&P traded well above its 50-day moving average, which is 3,976.32 last week. Full-year S&P earnings are expected to total 176 per share. At current prices, this puts the S&P at 23 times earnings, which equates to an earnings yield of 4.3% and an inflation-adjusted real earnings yield of 1.86%, using the 5-year TIPS break-even for inflation, which is currently at 2.44. Analysts are anticipating earnings in 2022 of 202 per share. At current prices, this puts the S&P forward earnings for 2022 at 20.3 times, or a yield of 4.9%, and an inflation-adjusted yield of 2.46%. Vaccine distribution is priced in Q3 2021, but distribution obstacles have increased, and efficacy for herd immunity will be closely watched. Redefining herd immunity may become the norm, so instead of a fully vaccinated population of 90%, we may accept a different goalpost for full vaccination. Perhaps it drops between 70% to 75%. Details are currently unknown. The market is currently pricing in an additional 4.82% move up or down by June 18th. The S&P 500 could potentially trade as high as 4,367.95 and as low as 3,975.48 by June 18th. The VIX is expected to move 6.81% or points. The VIX is currently at 17.32. The VIX price range is 18.49 to 16.21. The skew index is elevated, which indicates market participants are paying up for catastrophic protection. Those are two sigma events. Stocks continue to offer investors the highest real returns. The nominal yield on equities is 4.3%, while the nominal yield on 10-year treasuries is 1.63%. Real yields on all tenors of government bonds at the shorter end and belly of the curve are decisively negative, but real yields at the longer tenors above 30 years remain slightly in positive territory. Real yields on U.S. equities remain strongly positive. Disclaimer: with realized volatility below 12, there is a larger risk of systematic highly leveraged short vol strategies like equity vol targeting, trend following, and risk parity positioned for a massive increase in market exposure. The potential for a much larger move higher has increased, while the large sell-off has decreased. We are much more likely to see a fall in realized and implied volatility and a gradual melt-up in asset prices. The May-June VIX contracts at 19 and 21 are fairly priced. In fact, they may now be overpriced given the new economic outlook.